Hi, I'm Dennis from Prosperity Finance. Many borrowers are currently facing pressures as their loans come to due for repayment, and they worry about being unable to pay their loans on time. Currently, interest rates are high, and for borrowers used to low interest rate, seeing the current high rates can be stressful as repayment amounts increase significantly, adding more pressures to the borrowers. The most frequently asked two main questions: how to ease repayments pressure, which can be referred to our previous article, 8 ways to help you to relieve repayments pressures, and how to refix the loan interest rate. Today, we will discuss the current interest rate situation and future trends. The following content is intended for general information only. It does not take into account your specific financial situation or goals and does not include any personal financial advice. You should seek advice from your mortgage advisor before taking any action. Currently, the 6 months and 1 year fixed interest rate of mainstream banks are around 6.74%. The 18 months and 2 years fixed interest rate are slightly lower, and around 6.69 and 6.49%. The fixed term of 3 to 5 years has the lowest interest rate of all fixed term options, which is less than 6%. Typically, the official cash rate, which is the OCR, directly affects the floating and short-term interest rate, such as the 6 months and 1 year's rates. Economists predict that the OCR may rise once in May, but strong employment data announced this week indicates a saturated labor market and a lack of productivity gains. With the recent increase in net immigration numbers, demand will also rise, which will further affect the inflations. Therefore, the economist predicts that the rates may further rise, and short-term fixed rates may continue to rise for some time. The 18 months and longer fixed interest rate are related to the New Zealand Bank's overseas borrowing costs. Recently, both 18 months and 2 years rate have risen, which is related to the sudden interest rate hike by the Australian central banks. However, the economists predict that the medium and long-term interest rates have basically peaked. Looking at the long-term fixed interest rate of 3 to 5 years, banks have already lowered the rates. This indicates that the trend of long-term interest rate will continue to decline, taking into account of all factors. Although the interest rate for 3 to 5 years are the lowest, long-term fixed rates may not be the best options as the future interest rate may continue to decline. In addition, if you break your loan early during the fixed term, you will need to pay a high penalty fees. If you have plans to change, such as selling the house, long-term fixed rates may also cause an inconvenience as you will need to pay the high breaking fees as well. The 6 months and 1 year interest rates are relatively high and have upward trend. So short-term fixed rates may not be cost-effective unless you plan to repay or sell the property soon. In my opinion, choosing the 18 months fixed rate is more appropriate, as if the 2 years rate is also low, you can consider using some funds to choose the 2 years fixed term to diversify your risk. Finally, you should make the best choice based on your personal situation, future plans, and judgment of the economic trend. If you would like to learn more about how to fix your interest rate or need some information or require one-on-one advice, please feel free to contact us. We hope today's content can inspire you and you can contact us anytime. We will provide you the specific advice based on your situation. Thank you for your time and see you next time.